Now, when you pay cash, when you're transferring your money away, you're not paying interest to use your cash, but you're losing interest that your money could have earned. If the stock market goes up, your cash values will go up. If the stock market goes down, your cash values will still go up because the contractual guarantee will keep increasing your cash value to match the death benefit by age 100. Growth in cash value has nothing to do with what happens in the financial entertainment world. Think about the goods and services that you need in life. Someone has to finance it for you, and that someone should be you. It will be if it's your banking system doing it. By changing one thing, which is one process, not your cash flow, not taking any risk, all you have to do is just change your process, add one thing to what you already are doing, which is implementing this process in your life. You will make radical financial improvements for yourself, your family, and your business, and people who are depending on you. I'm going to get started with a very simple car financing example. And the reason why we're going to start with car financing is because car is something we can all relate with. We purchase cars at some point. We are going to buy cars at some point. But as I go through this example, folks, I would encourage you to think beyond cars. Let your imagination take over. There's a reason why Nelson, underneath the book, he calls it the infinite banking concept, because we cannot put boundaries around infinite. Now, in this particular example, a lot of frequently asked questions will also get answered. Questions regarding cash value growth. Warren mentioned there's daily cash value growth, a contractual guarantee to match the death benefit by age 100. So you'll see that. Questions regarding if I have to borrow money from the insurance company, because I understand we always want to borrow against our capital. We don't want to withdraw our money, because the moment you withdraw money, you stop the compounding, and then it's all downhill from there. You're borrowing against it. And if you're borrowing against it, what's the process like from the insurance company? Do I have to qualify, and what documentations are required? And what is my consent to repayment terms? What is the interest charged by insurance companies? So all those frequently asked questions will get answered. So again, word of caution. We've been doing this for many years. We've heard all the questions, and we've incorporated our presentation to answer all frequently asked questions as we go through the presentation. So financing. Now, how people finance things in life. So, Warren talked about some different ways. So we look at lease as one way of financing. We look at third-party bank financing, and we pay cash. Now, when you pay cash, when you're transferring your money away, you're not paying interest to use your cash, but you're losing interest that your money could have earned. So you are making a financing decision when you're paying cash. The decision is not to earn any interest on your money ever again. Whether you select option one, which is lease, option two, which is financing, traditional financing, or you pay cash, all three methods involve some sort of financing, and all three methods are a permanent transfer of wealth away from you. Now, I'm going to also say this, you're going to hear us repeat many things today, because repetition is going to be our best practice to learn. Now, some personal financing examples: car financing, appliances, furniture, home renovations; business financing example, building, office furniture, computers, photocopiers. So I'm just talking about so many things that we finance. And this particular example is tied to cars, but think beyond cars. Think what you can finance, or what you are already financing today. And if you change the process of how you go about financing, which is flowing through the system, how would that make it even better for you? The whole idea is not to change your cash flow. The whole idea is not to work any harder or take on any risk. It's all about changing the process to get to those objectives so that it's radically better for you going forward. All right, so let's talk about the better way for financing, and that is going to be the process of becoming a banker. So this family was introduced to IBC, which is the infinite banking concept, also called becoming a banker, in the year 2017. They were introduced to us via an existing client who already had been practicing this concept. And see, one of the values which is very new to and dear to us at Ascendant Financial is we want to empower you, and I'm speaking to anybody who's attending this session, we want to empower everybody via education, because the whole idea is to make sure that you are your own banker. That's what's called becoming your own banker. So we educate through boot camps, which is what you're doing today. We educate through book resources, through podcasts, through YouTube videos, which we'll show you later in the presentation. So when they came through the education process, they were age 40 at that time. Their goals were simple. They wanted to start by taking control over the financing functions of the cars that they're going to purchase in time to come. Their next car purchase was 2019. So in 2019, they wanted to be ready to purchase that car using their banking system and not someone else's banking system, because they saw the impact of how financing outside your own personal banking system depletes family wealth. Now, they want to build wealth for retirement without taking on any risk. So the contractual guarantee in the policy, which is by age 100, your cash values must match your death benefit. So every day as they became one day closer to age 100, their cash values in the policy kept increasing no matter what. If the stock market goes up, your cash values will go up. If the stock market goes down, your cash values will still go up, because the contractual guarantee will keep increasing your cash value to match the death benefit by age 100. Growth in cash value has nothing to do with what happens in the financial entertainment world. Stock market can go up and down. Interest rates can go up and down. Crypto can go up. Crypto can go down. Housing market going up and down, and same may apply to where you are. But all that does not impact the growth of your cash value. Cash values can never be less than what it is today. So if someone was setting aside money for retirement, they know for sure that the cash values will keep increasing every day, no matter what happens outside the system. And in addition to that, they wanted to create some life insurance. They had no insurance at that time. So God forbid, if something was to happen to either one of them, husband and wife, they want to make sure that this family can survive. We cannot bring the person back, but we can make sure that the surviving family can take the time to grieve and focus on the family and not worry about money. Let's just a few facts about them. So husband and wife, they both age 40, and the combined family income is $180,000. And they are savers. They've been setting aside $25,000 per year. And again, as Vern mentioned, when you save money, you've been saving money in someone else's bank. Me included, we would spend so much money on just financing cars than we would ever save for retirement. So let's get some group participation room, and let's see how many cars have you purchased in your lifetime so far. Now, purchase means leased, financed, or paid cash. So how many cars have you purchased in your lifetime so far? Go ahead and share that number. My number is 3. How many more cars are you going to buy in life? Think about that. And how much more wealth are you going to transfer away from your family? If all you do is take over the function of buying and financing cars in this system, you're going to be much ahead in passive income time, because you will be the one keeping all the money working for you throughout financing cars. So let's see that through this case study, how this family changed their process of buying cars. They didn't change their goal. They didn't change their cash flow. All they did was change the process of action of buying cars. Here's what they did. They started a policy in 2017 because they understood the problem. And they understood the solution, and they took action. So they started the policy right away. And the amount that they were putting into policy per year is $20,000. Remember, they were already saving $25,000 per year. So they didn't change the cash flow of saving. They just changed where the money is going to be sitting. That money is now being deposited as premium in a participating dividend-paying whole life policy. They're just changing where the money is going to be deposited. They're starting death benefit, so it's life insurance. So in exchange for their money, insurance company gave them a starting death benefit of $680,000, and immediately there was cash accumulation in the policy. Now, if they put 20K in the policy, and God forbid something happens to the husband because the policy is on the husband, the wife will receive $680,000 in tax-free death benefit. There is no tax on the payment of that benefit. Now, if he saved $20,000 in a bank and he died and he had no other life insurance in place, the only value that the family will receive is the equivalent to what's in the account. So in terms of protecting family, the objective was met. That's one of the objectives they had. For wife, we didn't start a policy. All we did was we just insured her life via term life insurance. And then as they start utilizing this process, as they gain confidence in this process, they can take that term life insurance that they have on wife and convert it into more whole life policies, more banking policies. So you guys, no different than how banks become profitable, they open more branches. Why? Because they want another set to flow more money. They want another entity to flow more money because they want to make more profit. That's why they open more branches. When we become more profitable, we open another family financing branch, which is another policy. Why? Because now we want to take over more banking function in our life going forward. No different than how banks would do it. The process of banking is pretty good. Make sure that it's working in your favor, not against you. All right, let's fast forward to 2019 when they were ready to buy this car. So they wanted to buy a Nissan Murano, and the price tag for the car was $35,000, as you can see on the screen. Now, their options were, so they had the same options that everybody else, but in addition to that, they had another option available, which is the process of becoming a banker. So the options were paying cash, finance, lease, the conventional ways of doing things, but they chose to do it using their banking system because they understand when they pay cash, when they finance, when they lease, they obtain the objective of buying the car, but someone else is getting all the money. They didn't want that anymore. So in 2019, here's what happened in the policy. The cash values were above $35,000. Remember, the contractual guarantee is that by age 100, cash values and death benefit must match. So in 2017, when they started the policy, the cash value kept increasing and is rising every single day. And by 2019, the total cash value accumulation was above $35,000. The daily cash growth, again, the cash values grew every single day. The daily cash growth just in 2019, because since 2019, the daily cash growth has increased. The daily growth in the policy is $20 a day. Now, how do I know this number so with such a high degree of accuracy? Because we can track these numbers. We look at what your cash value is today, and we log in the next day and look at what your cash values are the second day, the immediate second day. And the difference is that daily growth. That daily growth in your cash value stays the same over the annual year of the policy. And every year it gets better. Every year the daily growth becomes better. So back in 2019, when they bought that car, the daily growth was $20 a day. The capital required to purchase the car was $35,000. And they had more than $35,000 in their policy. So they could easily finance the car using their system. The death benefit had increased to over $750,000. So they started at $680,000 in death benefit in 2017. By 2019, the death benefit had increased to $750K. So remember the contractual guarantee, cash values must match death benefit, but your death benefit keeps increasing every year. And when your death benefit increases every year, your cash accumulation accelerates even more. And that's how we design the policy, where your death benefit increases, which is good from a estate planning standpoint, but increasing death benefit increases your cash value accumulation. And we achieve that by never, ever increasing your premium. Your premium stays the same no matter what. Now, how did they request a policy loan? So policy loan request is a single page document, and here's the input that's required to request a policy loan. Now, I'm going to walk you through how they requested a policy loan from insurance company, and then compare this with how you have been requesting loans from the bank to buy the car, and compare which one's easy. Because when we compare things, then we make a decision that, yeah, we're making progress, because it's all comparable. Compared to who? And that's how we know whether we're making progress or not. So all the form needs is your name, your policy, you're the policy owner, so they need to know who you are. So your name, your policy number, you put that on that form. How much amount do you need? What you can borrow as a loan from insurance company is equal to 90% of your cash value. So loan to value is 90% of your cash value. So you have to specify how much money do you need. And then all you have to do is let them know whether you want to receive this loan amount from the insurance company via check. So do you want them to send you a check, or do you want them to electronically transfer the money into a bank account, which is under your name, and they'll do it for you either ways. That's all that's required. There's no income verification. There's no qualification. There's no credit check. None of that is required to request a loan from insurance company. That's how easy it is. Now, contrast this by if you had borrowed a loan to buy a car using someone else's bank, what's the process like? And then obviously you sign and date it. All right, some more important facts in policy loan. If you request a policy loan and you have a policy loan outstanding, it does not impact your daily cash value growth. So for them in 2019, that daily growth, $20 per day, was never interrupted because it was a loan against it. They're not withdrawing their money. Policy loan outstanding does not reduce your death benefit value of life. Any policy loan outstanding when death occurs is deducted from your death benefit and the family gets the rest. But during your whole process of financing while you're alive, your death benefit never gets reduced. Policy loan outstanding does not negatively impact your future dividends. So it's a participating dividend paying whole life policy. If you have a loan outstanding It doesn't impact your dividends. That's the whole beauty about it. But there's certain companies out there which have a participating dividend being whole life policy. But if you request loans, it will impact your dividends, and we don't work with those companies. Policy loan outstanding doesn't show up on a credit report. It's a private loan. So when this family took out that loan, the collateral for that loan from insurance company was their cash value. So if they requested a loan for $35,000 of the cash value was used as collateral, meaning they cannot go back and access that money until they've repaid the loan. But all the $35,000 is still growing every single day uninterrupted. The lien for that loan is their death benefit. So in case they die and the loan is outstanding, it'll be deducted from the death benefit. Insurance companies cannot force or have terms on repayments. Policy loan repayment is 100% controlled by the policy owner. That's where you are in total and absolute control as a banker. So when they took that money as a loan to buy the car, technically they own the car free and clear because the collateral and lien is the policy, not the car. Whereas if you borrowed money from the bank to buy the car, the collateral for the bank loan is your car, but the lien is your income, because God forbid you default in the loan, they'll start garnishing your wages to get paid. There's no escaping it. Lien is your income, your livelihood. Think about that. Lien for this is your future dead self. Two different things. At death, any outstanding policy loans will get deducted from your death benefit. As simple as that. So insurance companies, they have collateral of cash values and lien on that benefit. So they'll get paid. That's why when they loan money to policy owners, there's possibility of policy owner defaulting is zero. Hence, they lend more money. You request money, they'll lend it to you, no questions asked. When you pay back the money, you can go back and ask for whatever you repaid plus more. And you can see that in this example, real time. Now, in 2019, the daily cash value growth was $20 per day. So now they have gone ahead, they've taken the loan from insurance company, they bought the car, they own the car free and clear. Now I'm showing you what's transpired in the policy. So that loan on the policy doesn't interrupt the daily growth, which is $20 a day. Policy loan initiated was $35,000. The money was received by them electronically in 7 business days. Now, here's another interesting fact. When you borrow money from anybody, if you're not using your money, there will be interest on it. There could be interest on it. Same applies to the insurance company. They charge interest on policy loans. That's one way for them to make profit, because they're making profit for you. Now, you all co-own the business, and you come to the insurance company and you say, you know what? We understand we are the co-owners of the business. Can we get some capital as a loan and we don't want to pay any interest on it? Would that be a good business decision to deploy capital to existing owners and not charge interest? If your answer is no, you're absolutely right. That won't be good practice. So they charge interest because they value capital. They value their capital for our benefit. We are existing owners. In paying back interest, we benefit from it by receiving dividends. We are all in this together. I take policy loans, I pay back interest. You have policies, you'll benefit. You take loans, you pay back interest, I benefit. We're all in this together. There's nobody else to share their profit with. So the interest is charged, a simple interest at 7% in 2019. It's reduced to, I think it's 6.2% now with this particular insurance company. Now, simple interest is charged on a daily basis. So 7% is the annualized interest rate. So 35,000 is what they had taken out to borrow money as a loan for the car. So 35,000 multiplied by 7% divided by 365. This calculates what their daily interest on that policy loan is. And they decide how to pay the principal and interest back in case they're not paying anything back. Everything is capitalized on their debt benefit. Just check this out. The daily growth is $20 because policy loan doesn't interrupt that. The daily interest is $6.71. So how are they doing so far? By borrowing money at 7% and no qualification. If I say to you today, for every $6.71 you give me, in exchange for that, I'll give you $20. How many times will you give me $6.71? Probably every single day and multiple times on Sunday, because it's in your best interest to do it. In Nelson's book, Becoming Your Banker, he talks about the whole process is about recapturing the interest that you're sending away to third-party finance companies. And this is what he meant. The family recaptured the cost of interest in the growth of the policy. And then when they pay the interest back, because they're not going to steal the piece, they're going to actually pay the principal and interest back. That interest becomes profit for the business that they co-own, which means more dividends. Have you heard news ever on CNBC that the company ABC died because it had too much capital? It never happens. Companies die because they have mismanagement of capital. But the more profit we put into our system, the more profit we all benefit from. Now, they decided to pay back policy loans to insurance company at $500 per month. They set their amortization based on their cash flow. Their cash flow was $500 per month. That's what they wanted to allocate to pay back policy loan. It'll take them 84 months to pay back the loan. They are in total and absolute control to pay back the loan. And they have a car that is owned free and clear. And the cash flows are still growing. And they have death benefit all at the same time. Now, monthly cash value growth. So let's do some basic math. So if it grows $20 per day, and let's assume there's 30 days in a month. So 20 multiplied by 30, the cash value is increased by $600. Monthly loan repayment is $500 set by them. Monthly interest is $201. So if you take $6.71, which is the daily interest, multiplied by 30 days, that's $201. So family's net worth over this transaction, and all they did was they changed how they're going to finance things. They're not changing their cash flow. They're not changing their objective. They're certainly not taking on any risk. All they did was change the process. So $600 is the monthly cash value growth. Now they're paying back $500 as loan. I'm going to subtract the $200 that they're paying as interest to the insurance company. So 600 plus 500 minus 200, that's $899. Where else can they pay back $500 a month on car financing and have access to $899? How is this compared to what maybe you have done in terms of financing cars outside of your system? All they've done is change the process. For every $500 per month in repayment, they have access to $899. A car is a depreciating asset. Just by changing how they're going to finance it, they convert it into an appreciating asset because the asset was never the car. The asset is always about stream of payment. And whosoever controls the banking function gets the stream of payment. So see what's happening for them. How many more payments do you think they should make to the policy if this is what's transpiring? And loan is at 7%. Who cares about the rate when you see the real numbers? If this was financed at 0% from a car financing company, they would have made a payment of $500 a month at 0% to car finance company. But how much of that $500 can they reaccess now? Well, let me give you the answer. It's zero. See, everything that we do in life is a measure against how everybody else is doing. So when you compare things, you can connect whether this is a good way to do it or it's not a good way to do it. Now, let's summarize. They're building wealth, cash value growth, while they're paying off the debt called policy loan. And it's beyond cash value growth because they're recapturing all the interest also. Now they're continuously compounding their family wealth. So the other goal that they had was to build money for retirement. So the policy kept on growing no matter what, building for future retirement as they're able to finance cars. And at some point, they'll be ready to finance investments. At some point, they'll be ready to finance family vacation. It's whatever they need. If the money is in the policy, they can always, and they should always access money from their bank versus someone else's bank. They have total and absolute control on loan repayment. They are their own bankers. Policy loan is private. It doesn't show up on TransUnion. If in fact, imagine the power in just keeping things private. If you are an investor and you keep things private, you can scale your investment portfolio. It's not even funny. It's how quickly you can scale it. And God forbid, if the husband died, he will leave no indebtedness behind to the family because any outstanding policy loans gets deducted from the death benefit. Family still gets to keep the car and all that boatload of tax-free death benefit that'll come walking in. Interest payment and policy loans adds more profit to the business that they co-own. Don't steal the peas. The more peace you have in the business, the more business can sell to make more profit for you and everybody else. And it creates more access to capital. They're paying back $500. It's their amortization. Then they have access to $899. Here's another thing. They can increase this loan repayment. They can reduce this. They control it. It could be zero if they wanted to. Next month, they can increase it to $1,200. They control the whole thing. There's no penalty on paying back or changing your terms. You are your own banker because it stays clearly on the contract. The policy owner controls it. Nobody else does. I have an important question to ask you today. Have you purchased your last car? Think about the cars that you still need to buy. Knowing what you know now, how much of your hard-earned money are you willing to say goodbye to? How much of your wealth are you willing to say goodbye to now? If your answer is zero, we can absolutely coach you on how to achieve it. We practice what we teach. It took me and my family about 6 years to get to a stage where we don't rely on commercial banks for any financing. We do it through our system. Varun mentioned a very important thing. He talked about instant gratification. If you love tea and you love coffee and there's instant tea, there's instant coffee, Well, in the era of instant coffee and instant tea, instant gratification doesn't exist. There's always delayed gratification. This process doesn't apply to just cars. It's limited to your imagination. Think about the goods and services that you need in life. Someone has to finance it for you, and that someone should be you. It will be if it's your banking system doing it. By changing one thing, which is one process, not your cash flow, not taking any risk, all you have to do is just change your process. Add one thing to what you're already doing, which is implementing this process in your life. You will make radical financial improvements for yourself, your family, and your business, and people who are depending on you. The most important question that we get is, hey, can you connect me with the right person on your team who can take a look at my present situation, what we are doing presently financially, and what our goals are? And can someone look at it and say, okay, how can this be implemented in our life to achieve our goals? The answer to the question is absolutely yes. You are going to receive a link to schedule your Becoming Your Banker call. It's a complimentary call. Don't bring any money to the meeting. There's no money required. That call is strictly about answering any additional questions that you have, and then seeing if it's a fit. We have a basis to work together, and also seeing how this can be applied in your life, whether personally or corporately. And to schedule your call, all you have to do is text the word schedule to 780-809-4599. and you'll get a link to schedule your call based on your convenience. You can select the end time that works best for you. I know, and you should know, that deep down inside, you should become your own banker. Now, here's the follow-up that you can expect going forward. We'll stay in touch via email. You'll receive an invite to schedule a time to meet. If we don't hear from you, just as a courtesy, one of my team members will reach out to you and see what day and time works best for you. We'll do a professional courtesy check-in. And if you prefer not to meet, just let us know, and that'll be it. There's no hard feelings. As long as you leave happy, that's all that matters to us. And in addition to that, if you schedule a call today, and at that call, the advisor is going to send you a copy of Nelson's book, Becoming a Banker, Unlock the Infinite Banking Concept, with our compliments. So schedule that call, and you'll get a copy of Nelson's book also. Again, our way of empowering you with more knowledge and education on the process of becoming a banker.